Okay, let's talk about a stock that is pure temptation for anyone who loves dividends. I'm talking about Dynex Capital. It offers something that honestly looks a little too good to be true. So the big question is this an income investor's dream or is it a financial trap just waiting to spring? Let's dig in and find out. So what's the first thing that just grabs you? It's this number. A dividend yield that is consistently, way over 10%. I mean, think about it. In a world where getting a few percent is considered a win, this is a monster. It's the kind of number that makes you just stop what you're doing and really pay attention. And just when you think it can't get any better, they hit you with the knockout punch. It's not just a massive dividend. It's paid out monthly, every single month. For anyone, and I mean anyone looking to live off their investments, that sounds like the absolute holy grail, right? A steady, high-yield paycheck. So, what's really going on here? Okay, that brings us right into our first part, the monthly paycheck promise. We're going to really unpack what makes a stock like Dynex Capital, ticker symbol DNX, so incredibly magnetic for people who just want their money to work for them, to generate that regular cash. When you get right down to it, the appeal really comes down to these three things. First, and this is the star of the show, that crazy high dividend yield. Then you've got the monthly payments, which feels just like getting a salary. And hey, on top of all that, there's always the chance the stock price itself could climb. It really looks like the whole package. But how on earth do they pull it off? Yeah, that's the million-dollar question, isn't it? How can a company afford to pay out so much, so often? Well, that takes us right inside the engine room, into what we'll call the mREIT machine. Let's pop the hood and see how this thing actually works. So, Dynex Capital isn't your typical company. It's a special kind of beast called a mortgage REIT, or for short, an mREIT. And the concept, when you boil it down, is actually pretty simple. Think of them as experts in financial arbitrage. Their entire game is to borrow money for cheap, use it to buy assets that pay them a higher interest rate, and then they just pocket the difference. So here's how that model plays out in just 4 steps. Step 1, they go out and borrow money at really low short-term interest rates. Step 2, they take that borrowed cash and buy up a bunch of long-term mortgage assets that pay them a much higher rate. Now, step 3, the profit, that's the gap, the space between what they pay in interest and what they earn. It's called the net interest spread. And here's the kicker, step 4. Because they're a REIT, they are legally required to distribute at least 90% of their income to shareholders. And that, right there, is where that giant dividend comes from. Okay, so right about now, you're probably thinking, wait a minute, what happens if people just stop paying their mortgages? And that is a fantastic question. But here's the key detail. The vast majority of what Dynex owns are something called Agency MBS, or mortgage-backed securities. And the agency part means they're guaranteed by the U.S. government. That completely takes the risk of people defaulting off the table. The credit quality is, for all intents and purposes, rock solid. So far, so good, right? I mean, government-backed assets, a straightforward way to make money, it sounds almost perfect. But this is where the story takes a sharp turn. This is what we call the high wire act, because that powerful business model is balancing on a very, very thin wire, with 2 major risks that define the whole operation. So what's the catch? Come on, you knew there had to be one. With yields this high, there is always a catch. And yeah, that government guarantee is great. It wipes out credit risk, but it does absolutely nothing to protect them from 2 other huge risks. All right, risk number 1, and this is the big one, the yield curve. You really need to think of this as the company's absolute lifeline. When the yield curve is steep, that's the situation on the left, their business model is basically a money-printing machine. They're borrowing cheap and lending for a lot more. But when that curve flattens out, or even worse, inverts like you see on the right, poof, their profit margin gets absolutely crushed. Their whole operation is basically at the mercy of whatever the Federal Reserve and the bond market decide to do. And the second major risk? Leverage. Remember how step 1 of their whole business was borrowing money? Well, let me be clear. They borrow a lot of money. And that leverage acts just like a magnifying glass. It makes the good times great, right? When that interest spread is wide, their gains are magnified into huge profits. But it's a double-edged sword. When that spread shrinks, the losses get magnified just as much, just as violently. So, what happens when these risks stop being just ideas on a slide and become reality? What happens when that high wire finally snaps? Now we're going to talk about the real-world pain, the actual consequences for an investor who gets caught when things go wrong. And here's what that pain looks like. That beautiful monthly dividend you fell in love with, it can be gone in a flash. It's incredibly volatile. Dividend cuts aren't just a possibility, they're pretty common when the market gets shaky. The company's actual net worth, its book value, can fall off a cliff. And to top it all off, they might be forced to issue a ton of new shares, which just waters down the value of your own investment. Okay, if you take away only one thing from this whole explainer, let it be this. This is the crucial point. That high monthly dividend, the entire reason people are drawn to this stock, it is not guaranteed. It's not a promise. It's not like a bond payment. It is a direct reflection of the market, and you better believe the company will slash it, often, if that's what it takes to survive. All right, so we've seen the incredible upside, and we've seen the terrifying downside. Let's wrap this all up and try to answer that big question. Who is this kind of investment actually for? This chart really lays it all out pretty clearly. If you're thinking about something like sauce, you need to be a pretty sophisticated investor who really understands and can stomach a lot of risk. The number one reason to buy is, of course, that huge monthly dividend. But the number one warning is that the dividend is anything but stable, and you're riding a wave that's totally controlled by interest rates and leverage. And hey, if you do decide to jump in, you have to watch two numbers like a hawk: the net interest spread and the book value per share. Those are the numbers that tell you what's really going on under the hood. And so that brings us to the final critical question. And this is one that only you can answer for yourself, for your own money. Now that you've seen how the machine works, the incredible promise, and the very real danger, is that extraordinary yield really worth the extraordinary risk?